You wake up one morning and your savings are still there. The number hasn't changed. But when you try to use it, to buy something from another country, to move money across a border, to settle a transaction that used to be automatic, the system hesitates. Not broken, just slower, more expensive, less certain. You're told everything is fine. And technically it is. Your currency still works. Your bank still opens. But somewhere beneath the surface, the infrastructure you never thought about is quietly being replaced. You're not losing access to money. You're losing monopoly over which money matters. For your entire life, the US dollar has been the default setting of global commerce. Not because it was voted on, not because it was the best, but because after 1944, it was the only option that made sense. The world's largest economy, the most stable military, the deepest capital markets. The dollar became the lingua franca of value itself. Countries didn't choose it out of love. They chose it because there was no alternative. But that arrangement came with a price. And the price was control. If your reserves were held in dollars, your wealth could be frozen. If your trade depended on dollar rails, your access could be severed. If you disagreed with Washington, your financial sovereignty became negotiable. For decades, that was simply the cost of participation in the global economy. Until it wasn't. The system everyone trusted was called dollar hegemony. It wasn't just that oil was priced in dollars or that central banks held dollars in reserve. It was deeper. It was structural. The entire scaffolding of international trade, the clearing systems, the settlement mechanisms, the correspondent banking networks, all of it ran through institutions that could be controlled by a handful of governments. This gave the United States something economists called exorbitant privilege, the ability to borrow cheaply, the ability to run deficits without immediate consequence, the ability to print money that the rest of the world needed to hold, and most powerfully, the ability to exclude. Sanctions became a weapon, not military force, not diplomatic isolation, financial exclusion. Cut a country off from dollar access, and you cut them off from the global economy. For decades, this worked because there was no escape hatch. You could complain about the system, but you couldn't leave it. February 2022 changed that assumption. When Russia invaded Ukraine, the West responded with something unprecedented. They froze over $300 billion of Russia's foreign reserves. Money accumulated over decades, stored in Western banks. Gone. Not destroyed, just made inaccessible. The mechanism was simple. Russia's wealth existed as digital entries in financial institutions that fell under Western jurisdiction. And with the stroke of a pen, those entries were locked. This wasn't a fringe nation. This was a nuclear-armed G20 economy. And the message was received everywhere else. China watched. India watched. Saudi Arabia watched. Indonesia, Turkey, Brazil, Egypt, every country that had ever had a policy disagreement with Washington or Brussels watched. And they all thought the same thing. If it can happen to Russia, it can happen to us. The system that guaranteed stability now guaranteed vulnerability. Because the infrastructure of global finance had become a tool of coercion. And coercion, once demonstrated, becomes impossible to ignore. Finding an alternative went from a theoretical discussion to an urgent national security priority. Not because these countries wanted to destroy the dollar, but because they wanted insurance against it. In January 2026, that insurance became operational. The BRICS alliance, Brazil, Russia, India, China, South Africa, now joined by Saudi Arabia, Egypt, UAE, Ethiopia, and Iran, launched a new settlement system. They called it the Unit. Not a proposal, not a trial, a functioning alternative. 40% backed by physical gold held in vaults across member nations. 60% backed by a weighted basket of BRICS national currencies. Designed to be stable enough to trust and dynamic enough to grow. The system didn't attack the dollar. It simply built a parallel track. Countries could now settle trade without ever touching a US dollar. Oil from Russia to India. Electronics from China to Brazil. Agricultural products moving across borders. All of it flowing through unit-based settlement. This wasn't theoretical. Russia and China had already been doing it for years. By 2026, roughly 90% of their bilateral trade, hundreds of billions of dollars in value, was conducted in rubles and yuan. $0 involved. The unit was just the formalization of a route that had already been tested. And it worked. The scale is what makes this irreversible. BRICS nations now represent 46% of the global population. Over 3.6 billion people. a combined GDP exceeding $28 trillion control over critical resources, oil, natural gas, rare earth minerals, agricultural commodities. This isn't a coalition of minor economies making noise. This is half of humanity building a financial system that doesn't require permission from the other half. The unit launched with instant demand because the user base already existed. These countries were already trading with each other. They were already seeking ways to reduce dollar dependency. The infrastructure just made it easier. And for every country outside BRICS watching this happen, the existence of the unit creates something that didn't exist before. Optionality. The danger to the dollar isn't collapse. It's erosion. Every transaction settled in units instead of dollars reduces global demand for dollars by a tiny increment. Individually, meaningless. Cumulatively, structural. Because the exorbitant privilege depends on universal necessity. The moment the dollar becomes optional, even for a fraction of global trade, the entire arrangement begins to weaken. The entire arrangement begins to weaken. Countries stuck in dollar-denominated debt traps start exploring alternatives. Nations facing sanctions realize they have a backup system. Developing economies caught between US and Chinese influence suddenly have leverage they didn't have before. They don't have to choose sides completely. They can diversify. Some trade in dollars, some in units, some in euros, some in yuan. The world isn't splitting into two clean blocks. It's fracturing into a multipolar financial ecosystem where the dollar remains important, but no longer indispensable. And once that process begins, it becomes self-reinforcing. The more countries use the alternative, the safer the alternative becomes. The safer it becomes, the more countries are willing to use it. This is how monopolies die, not in a single dramatic moment. This is how monopolies die, not in a single dramatic moment, but through 1,000 small defections over time. But there's a vulnerability the BRICS nations haven't solved. Unity. China and India have active border disputes. Russia and China compete for Central Asian influence. Brazil's democratic government has little in common with Russia's authoritarian structure. Managing a shared currency system requires surrendering significant monetary sovereignty. Who controls the gold reserves? Who decides policy during a crisis? What happens if one member's economy collapses? These are the questions that nearly destroyed the euro during the Greek debt crisis. And the eurozone had far more political and cultural integration than BRICS has. The greatest threat to the unit might not come from outside. It might come from internal fracture, from competing interests, from the simple difficulty of maintaining coordination among nations that don't fully trust each other. Western analysts are counting on this. The belief that BRICS will eventually collapse under the weight of its own contradictions. But there's a counterargument. Shared opposition is a powerful unifying force. These nations may have differences, but they share one overwhelming interest: reducing dependency on a system that can be weaponized against them. And that fear, grounded in the very real memory of $300 billion frozen overnight, may be strong enough to hold the alliance together, at least for now. So what does this mean? Not that the dollar dies next month. Not that your savings evaporate. Not that the global economy collapses into chaos. It means the rules are being rewritten. For 80 years, the dollar has had no competition. Countries held it, traded in it, borrowed in it, not because they loved it, but because there was no alternative. Now there is. And the existence of an alternative changes everything. Not immediately, not dramatically, but inevitably. The United States will still be able to borrow, but perhaps not as cheaply. It will still run trade deficits, but perhaps not as easily. It will still use financial sanctions, but perhaps not as effectively. The exorbitant privilege doesn't disappear overnight. It just gets smaller, year by year, transaction by transaction, until one day, it's no longer exorbitant, just ordinary. What kind of person survives this shift? Not the one who panics, not the one who hoards, not the one who picks a side and bets everything on it. The person who survives is the one who understands that systems change slower than headlines suggest, but faster than institutions admit. The one who doesn't confuse the permanence of infrastructure with the permanence of arrangements. The one who knows that monopolies always feel eternal until the day they don't. The BRICS unit is live. It's operational. It's functional. It's being used. This isn't a warning. It's not a prediction. It's a description of something that's already happening. The world is not splitting cleanly in two. It's becoming more complex, more fragmented, more negotiable, And navigating that world requires understanding one simple truth. The systems you trust without thinking are the ones most vulnerable to change. The era of unchallenged dollar supremacy is over. What comes next won't be decided by governments alone. It will be decided by millions of transactions made by thousands of institutions across hundreds of countries, all choosing, gradually, where to place their trust. And trust, once divided, is very difficult to reunify.